What's up, everybody? My name is Joe Brown, and this is Heresy Financial. On Friday, the September wage numbers came out, and it showed a spike in wages to the point where the recent trend in how fast wages are rising, other than a small blip in 2020, it's the fastest wage growth that we've seen since the data started to be collected by the Bureau of Labor Statistics in 2007. So in this video, we are going to talk about why, though it appears like that's good news, why it's not actually the best news in the world. Ready? Let's dive in. All right, so the September wage numbers came out, and it's showing that the trend is we are having the fastest growth in wages since this data started to be collected in 2007, again, outside of a little blip in 2020. CNBC released an article about this saying that shows that inflation might not be as transitory as many economists were expecting, that it might be a lot more persistent. So we're going to talk about the relationship between inflation and wages here, and I want to point you to a chart here. We're going to be looking first at the average hourly earnings of all employees. Now, this chart that you're looking at, this is change from a year ago in dollars per hour. So you can look at the spike that happened at the beginning of 2020. That was temporary, fell back down, right? And then as we look from the last couple of months, what we're seeing here is, other than that spike in 2020, we're seeing the fastest growth in wages. Now, keep in mind, this chart is showing the change from the prior year. So now let's take a look at the same data, just not the change from the prior year. We're just looking at the absolute level. And we can see clearly there was that spike in 2020 that came right back down. But what you'll notice is that wages are persistently higher. The growth in wages is persistently higher than the trend was before 2020. And so if you look at this red line, that's the trend starting from the beginning of the data through the beginning of 2020 there. That trend is a lot lower than where we're at now. And where we're at now, you can see here as we zoom in, has been turning up. And so wages are on the rise, and it looks like that is a persistent and not temporary rise in wages. Now, there are a few very obvious reasons for this. Number one, there's a labor shortage, right? Businesses all over the country are looking for labor. And so what they have to do to attract labor, they have to raise their wages. They have to pay more. They have to offer a better job or better terms, better hours, whatever it is. But one of the key components to attracting labor is to pay more, right? So that's very obvious. So this obviously comes as great news to anybody whose wages have gone up, anybody who has gotten an increase in their income. But the problem is, wages are not the first thing to adjust to new money entering an economy. When new money gets injected through fiscal deficit spending that is funded by monetary expansion, which that's what we've been seeing primarily for the last year and a half, whenever that takes place, the first thing that you see react is you're going to see asset prices go up. The next thing that you're going to see is you're going to see consumer prices, just the cost of stuff, the cost of living will go up as a result, because as that money makes its way through the economy, makes its way from the hands of the rich into the poor, that money is going to start getting spent on stuff, because the rich, when they get new money, they buy assets. When the poor get new money, they buy stuff. And so proportionately for the amount of income that they have, they're spending almost all of it on consumer goods. And that makes sense, right? If you can barely make ends meet, you get a little bit more money, you're going to buy food, you're going to buy clothes, you're going to buy a car, you're going to buy the normal stuff that you need to live. So as this new money makes its way through the economy, it starts bidding up prices. It doesn't hit wages, though, until the very end. So we're seeing it now start to hit wages, and we're seeing this spike in wages take place. The problem is, it's coming after the cost of living has gone up for everybody. And so if you've been waiting for this wage increase and finally you've got it, you've already been living for 3 months, 6 months, a year, while paying a lot more to just survive and waiting for the new money to make its way into wages. Now, it eventually gets there. It's just that everybody who needed it and was waiting on it is worse off in the long run, because their cost of living goes up before your income goes up. Now, it's important important to keep in mind that the stages in which inflation moves through the system are the same in which deflation moves through the system. So deflation as well hits assets, then goods and services, and then wages. So in a structural deflationary system, you have people making hourly wages without getting a raise get wealthier every year because the stuff gets cheaper before their wages get cut. All right, so we see that wages are going up. It's good news, though not as good as news as it might seem because it is preceded by the cost of living going up. Inflation happened to goods and services first, and then it hits wages. But there is a second reason. An increase in wages can actually contribute to more inflation. And the reason for that is because prices of things are going up. And so if income stays the same, eventually those prices will have to come back down because there just won't be enough demand at the higher prices. In order to support those high prices, there's just not enough income to continually make all those purchases. And so prices will have to come back down to a point of equilibrium until the income is able to afford the price. But as prices go up, if income continues to follow along behind it, that sustains the demand to continue to drive prices up in the future. And so while an increase in wages may feel very helpful for somebody right now, if it's happening broadly, many times what you see is that the cost of living continues to go up because across the economy, that boost in income drives higher demand, which pushes prices even higher. Now, it's also important to note that there are many other factors contributing to higher and higher inflation right now. One of them is the supply chain disruptions, the shortages all around the world. I made a whole video about that. I suggest you go and take a look at that. If you have any questions about why the supply chain disruptions have maintained for so long and why it looks like they're going to continue to be disrupted into the future. But there are a wide variety of factors right now that are all forcing inflation higher. They're all kind of pouring in from all different angles, these inflationary pressures that make it seem like there's not much that can be done to rein that inflation in, other than just going full out attacking inflation from the monetary policy standpoint. Even from fiscal policy, you start to withdraw money from the system, start to do quantitative tightening, spiking interest rates. The problem with that is that we've got a very fragile economy that's built on debt. And if you start to withdraw money out of an economy and raise interest rates, then all of the debt that's being serviced by rolling it over, so you have to take out new debt to pay off the old debt, is the economy and the government is unable to afford to roll that debt over, and you have insolvency step in and you trigger a deflationary death spiral. Now, ultimately, I think that's the far healthier option for an economy long term. However, that is not the decision that is usually made by policymakers. They usually tend to lean towards risking hyperinflation or very, very high and persistent inflation, and they stay away from deflation at all costs. And finally, I'm going to be at the Market Disruptors live event that Mark Moss is hosting in Miami, November 12th through 14th. If you have the ability to go, I would love to see you there. I've got it linked in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.